Imagine giving two nerdy college kids $500,000 and they turn it into Facebook, or putting $250K into a startup that rents out air mattresses and then cashing out billions from Airbnb. Welcome to the world of venture capital, where you take bets with other people's money, lose 9 out of 10 times, and still make billions of dollars in the process. But how do VCs actually turn nerdy kids into startup billionaires? Why do some VCs end up richer than the founders themselves, and how do they pick the winners? I'm going to answer all of these and many more in this video. Let's go.
Venture is basically just a bunch of soulless cowards.
Venture capital is a form of investment that takes money from rich people, pension funds, and institutions and invests it into risky, early-stage startups. The goal? Massive returns. We're talking 10, 50, sometimes even 100x your money. But there's obviously a catch. Venture capital is a high-risk, high-reward game. The majority of startups fail, and so the majority of VC investments lose money. You can think of venture investing like betting at a roulette table. Except you're only allowed to bet on the individual numbers. And sure, you might be able to place more of a macro bet on a specific industry or technology, but ultimately it's a game of very few winners. So why would anyone bother with this kind of investing? Because all it takes is one massive win. Take Jason Calacanis, for example. This guy basically built his entire career off of a single investment. He put $25K into Uber in their seed round, when they were valued at around 4 to 5 mil, and later put in another $300K. When Uber IPO'd in 2019 at an $82 billion valuation, his $325K investment was now worth around $100 million. An important distinction though, Cal is actually an angel investor. These guys often get confused with venture capitalists, so I thought I'd clear it up. Angel investors are typically wealthy individuals who invest their own money into early stage startups, while VCs invest other people's money. Here's a table breaking down more of the differences if you wanted to pause and have a read. Now, how do venture capitalists actually make their money? Well, if you watch my other video on hedge funds, the fee structure is basically the same. They charge around a 2% management fee each year and then take 20% of the profits they make. In VC lingo, the fee on profits is known as carried interest, or just carry. And that's how they make the big bucks. But it's pretty risky, and here's why. In order for them to turn their ownership in a startup into actual cash, the startup has to have an exit, meaning their stake or the entire company has to be bought by another, or the company has to go public. Do you know how many companies make it to this stage? Around 1 to 3%, and far less than 1% ever go public. This is what makes venture capital a fundamentally different game to public equities trading. You're expected to lose the majority of the time, but you're also expected to cash in big when you finally do hit a winner. So how do they structure the deal so that they make sure they win big on the home run companies? You've just pitched a VC, they've agreed to give you a few $1 million. Now what? They don't just transfer you the cash and call it a day. Every deal comes with what's known as a term sheet. Think of it like a startup prenup. Here's some of the key points the term sheet will probably cover. First and foremost, valuation. How much the startup is worth. Then equity stake. How much of your company the VC gets in exchange for their cash. Then something that's known as the liquidation preference. And this is a sneaky little clause that ensures VCs get paid first if the startup sells or goes bankrupt. Then we've got anti-dilution clauses, which protects the VC's stake if future fundraising rounds happen at lower valuations. And finally, board seats and control. VCs usually want to say in key decisions, so they'll typically ask for board seats. The bigger their stake, the louder their voice. In other words, these deals aren't just about money, they're also about power and control. Let's now back up for a minute. At what point did we get in contact with the venture capitalists? Was it before we had any customers? After we'd grown to 10 million revenue? When's the appropriate time to get money? It's time to dive into VC funding stages. So there's a number of different stages throughout a startup's life that VCs might decide to jump on board. The earlier the riskier, the later the higher the valuation, and the more money they'll have to pay. Let's break it down. So you've got your seed stage. This is your classic garage startup stage. At this point, it's usually just a good idea, maybe a rough prototype, and zero revenue. Checks will typically range from $50K to a few $1 million. Then we've got Series A. At this stage, startups usually have an actual product, some real customers, and steady growth. Although they're probably not profitable just yet. Series A rounds can range anywhere from 5 to 15 mil. Then we've got Series B. Shit's starting to get serious. Startups have some serious traction, they've probably found product market fit, and revenue is climbing. Now it's time to scale big. Expect around 15 to 50 mil raised during this stage. And finally, we've got Series C and beyond. These are the late stage rounds, reserved for companies crushing their markets and preparing to either IPO or get acquired. At this point, funding can be anywhere from 50 mil to even $1 billion. Okay, so now we know what VCs are and how they're different from angel investors. We know how they get paid and how they structure their deals. And we also know the different stages in which they'll invest in a startup. But what do they actually do all day? If you're picturing a VC sitting back, casually throwing around millions and waiting to cash in, you're honestly not that wrong. Remember,
Venture is basically just a bunch of soulless cowards.
But there's a bit more to it. Most of their day is actually spent doing 3 things. 1, listening to pitches. They'll listen to dozens, if not hundreds, of pitches from overly confident founders who think they're God's gift to earth. But you've got to dig through a bunch of shit in order to find a diamond. Second is due diligence. If a startup catches their attention, it's time to do a deep dive, crunching numbers, grilling founders, analyzing markets, calling references, and figuring out if there's actually a billion-dollar company hidden somewhere in there. And finally, managing their portfolio. Once they've invested, the VC acts as an advisor, therapist, cheerleader, and occasionally executioner. They'll help startups navigate growth, manage crises, raise follow-up rounds, and hopefully exit successfully. Basically, a VC's day-to-day boils down to sorting through endless hype, searching for genuine potential, and trying not to lose other people's money. At least not all of it. But that brings up a big question. How do VCs actually decide who's worth betting on? So like I said before with the roulette example, it's a bit like gambling, and it's definitely a numbers game. You're never going to find successful VC firms only invested in a small handful of companies. They're investing far and wide. So even though it's a very risky game, smart VCs have criteria that tilt the odds a little more in their favor. Here's what they look for. First up is team. Unlike stock picking, there's no financials and historical data to dive into and analyze. So the most important part of a startup is its people. Seriously, it's not even the idea. Good founders will be able to pivot from a losing idea and change it to a winner. You've probably heard of Slack, the cloud-based team communication platform. What you probably didn't know was that these guys started off by building a video game. It was trash, but part of their game that wasn't so shitty was the chat rooms they'd built into it. After a certain point, the founders pivoted from their stupid video game idea, culled a bunch of employees, and turned it into the killer company it is today. Okay, after team, you've got market size. This is often referred to as TAM, or total addressable market, and it better be in the billions of dollars. Next is what's known as product market fit, and this is easily one of the most important. It's basically asking, does your product solve a genuine painful problem, or is it just a solution looking for a problem? VCs want proof that you're solving a real problem, otherwise it's just a cool idea. Then there's startup traction. Are sales actually growing? Are users loving the product? VCs are basically obsessed with momentum. Why? Because if your user base and revenue is growing, they're more likely to be able to pitch your company to other VCs or companies who might want to buy you out, which would either inflate their stakes value or allow them to exit at a profit. And finally, there's competitive advantage, also known as moat. Can the startup defend its turf, or can it easily be copied and crushed by Amazon, Google, or some hungry competitor? Ultimately, VCs are looking for startups with the highest likelihood of realistically becoming billion-dollar companies, because all they need to do is find one massive winner. Speaking of winners, who are the most successful venture capitalists and what were their biggest wins? Let's start off with Chris Sacca, the cowboy of Silicon Valley. Not really, he just loves wearing cowboy shirts. You might already know him from Shark Tank, but what he's known for amongst VCs was his first fund, Lowercase Capital. He became famous because his fund returned roughly 250 times the money they invested. Imagine that. You're a fairly wealthy individual, and so you give this cocky venture capitalist $1 million of your money to play with. And a couple years later, he sends you a check for around $200 million. Some of the companies he invested in that got him these returns? Uber, Twitter, Instagram, and Stripe. And he's got a current net worth of something around $1.2 billion. Then we've got Mark Andreessen, who looks like he could be cast for the live-action roleplay of Humpty Dumpty. Nonetheless, he's actually quite the genius and co-founded the legendary VC firm Andreessen Horowitz with Ben Horowitz, who if you'd like to read about more, I'd highly recommend his book, The Hard Thing About Hard Things. The fund now manages over $35 billion in assets, and famously invested in companies such as Facebook, Airbnb, Coinbase, and Slack, all multi-billion-dollar IPOs or acquisitions. If you want to hear more about Mark, he's done a bunch of podcasts with Joe Rogan, Lex Fridman, and Tim Ferriss. And finally, we've got the dictator himself, Chamath Palihapitiya. Originally an early employee at Facebook, Chamath then used the money he made from Facebook to start his venture fund, Social Capital, with a couple of his most memorable deals being turning a $20 million investment in Slack into around $1 billion once it IPO'd, or buying around $1 million worth of Bitcoin back in 2012 when it was trading for around $80 a coin. If you guys wanted to hear more from Chamath, I definitely recommend listening to the All In pod each week. 3 billionaires and Jason Calacanis talk about a lot of super interesting stuff, often related to startups and tech. So, what do you guys think? Would you want to be a venture capitalist? Personally, I would. Let me know in the comments below what other videos you'd like me to make. I'm currently planning on focusing more within the finance niche, but if there's specific videos you'd want, I'm always open to suggestions. As always, thanks for watching. Please remember to like, comment, and subscribe, and I'll see you in the next video.